Millions of Americans are losing money from their retirement plans as the stock market continues its downward trend. The S&P 500 has dropped around 18% since the start of the year. But despite those losses, the market is still up from where it was before the pandemic began. It's good to keep that in mind. Frances Stacy joins me now. She's the Director of Strategy at Optimal Capital. Frances, great to have you with us. It is good to have some perspective on the market, right? It's down, but it's still up if you look at sort of, year over year, right? So what advice do you have for people who are looking at their 401ks right now and are scared about the losses they're seeing?
Well, I can understand why they're panicking. In previous drawdowns, they were short-lived, particularly even though the COVID drawdown was 34% in the S&P, it happened over a period of 28 days, and then it aggressively came back up because the Federal Reserve intervened. And so by the time someone's looking at their balance in their 401k from a quarterly perspective, even though it dropped quite substantially, I'm sure, by the time they saw it, it wasn't so bad. This is more of an orderly bear market where things just leg down incrementally. And yes, I agree that people are probably very scared. I think my best advice is to go to your 401k provider or go to a financial expert, a financial advisor, and ask them to look at the options in your 401k. The way that most 401ks are constructed is they have options of available funds that you can allocate your money into. Many 401ks have mutual funds, and then you have to have a financial professional dig into that mutual fund and see what the underlying assets are that they own. And I would generally say to people that we have further to go to the downside for the market. So ask your provider or a financial expert to look at your 401k options and get you into a more defensive strategy.
Okay, so you do think we have further down to go. How much further down do you think we will be going?
Well, it just depends entirely upon the Fed. It depends on if they stick to their tightening schedule. I don't think that they're going to be able to stick to their tightening schedule. And we have the minutes coming out tomorrow. But thus far, Jerome Powell has not given us any idea that he's not fully planning on sticking to the tightening that's priced in already from this year. And the thing about the tightening that's priced in currently, when you look at the projected rate hikes going forward and also the balance sheet reduction going forward, all of which reduces the aggregate size of the money supply, which reduces the aggregate size of the system. We're doing a similar course of tightening in a one-year time span as we did last time when he had to pivot when the S&P 500 sold off 20% in late 2018.
Okay, so just to reiterate, your advice for those who are close to retirement and who are worried about it is to get in touch with a financial advisor, dig into your mutual funds, tease out those assets that are what? Which are the assets you think they should be shedding right now if they're planning on retiring in a year or two?
Well, the anomaly about this sell-off is that stocks and bonds went down together. And so the bonds were not able to buffer the losses of the stocks. We think that because the Fed is not going to be able to tighten as much as has been yet projected into the market, we think that fixed income, particularly Treasury bonds, are going to have more of possibly a bull market into the end of the year, because if it's projected that we're going to have 7+ hikes left to go this year, and the Fed is forced to pivot because the market sells off too much, growth decelerates too much, or goodness forbid, we have a shortage of liquidity in the system, which caused them to pivot during COVID and also in September of 19 after that tightening iteration when they had a spike in the overnight market. So we know that he pivots when there's not enough liquidity in the system. And should that happen and we don't get those projected rate hikes in, then bonds, and particularly duration, is going to be the place to be.
All right, bonds. All right. Well, Frances, Stacy, thank you so much. We do appreciate your insight. Thanks for joining us.
My pleasure.